You're watching a system break in real time. On January 25th, 2026, silver pierced through the psychological threshold that markets had been watching with increasing dread. The price reached $102.95 per ounce, breaking through barriers that mere weeks ago seemed impossible, shattering records that stood for over 4 decades. This is not a rally. This is a rupture. The number itself tells only part of the story. What matters more is what that number reveals about the architecture underneath. When silver broke past its 1980 high of $50.36 per ounce in October 2025, analysts called it historic. When it hit $82 in December, they called it parabolic. When it touched $95 on January 20th, they ran out of words. Now, at over $103, the market is screaming something that few want to hear. The old rules are gone. This is the moment when price discovery moves from the paper world to the physical world, when futures contracts become meaningless abstractions, when the men in suits who controlled commodity prices for generations discover they never actually owned what they claimed to own. The silver market is not rallying. It is fracturing. And fractures, once they start, do not stop until something breaks completely. Now we need to talk about what should be impossible. In the classic financial textbook, when a commodity rises this aggressively, it signals overheating, speculation, a bubble forming that will inevitably collapse back to reality. But silver's rise is not happening in isolation. It is happening alongside gold, reaching $5,088 per ounce, up 85% in a single year. It is happening alongside Bitcoin recovering to $87,665 despite regulatory headwinds. It is happening alongside collapsing Treasury yields, a dollar index bleeding 9% in 90 days, and real interest rates turning decisively negative. This correlation should not exist. When stocks rise, bonds should fall. When inflation cools, hard assets should retreat. When central banks signal easing, safe havens should lose their appeal because economic stability returns. Instead, everything that stores value outside the traditional system is moving in the same direction simultaneously. Gold, silver, Bitcoin, even platinum and palladium. Everything except the currencies themselves. This is not a market behaving normally. This is a market pricing need in the debasement of money itself. Consider the mathematical impossibility of what silver has achieved. A 241% gain in 12 months, a 110% surge in just 90 days. This is not the behavior of an industrial metal responding to supply and demand curves. This is the behavior of an asset that has been fundamentally mispriced for years, suddenly snapping to a new equilibrium at velocities that make pricing models irrelevant. The technical analysts who predicted resistance at $60, then $80, then $100 have been obliterated by reality. The market is not following their charts, it is rewriting them. The Federal Reserve cut rates to 3.75% in October 2025, citing progress on inflation that had fallen to 2.7% year over year by December. This should have been the signal that the emergency was over, that normalization was returning, that there was no reason to flee into metals that pay no interest and cost money to store. Instead, it triggered the opposite reaction. Gold and silver exploded upward precisely because the cuts revealed what the Fed would not say. They had lost control. They had to cut, not because they conquered inflation, but because the debt load made higher rates systemically impossible. The market understood what the Fed tried to hide. Zero real rates are not a choice. They are a requirement. When you cut rates while commodity prices explode, you are not defeating inflation. You are surrendering to it. You are choosing to debase the currency rather than defend its purchasing power. The market sees this clearly now. That is why silver is not falling when it should. That is why every technical correction lasts hours instead of weeks. That is why physical buyers are stepping in at every price, refusing to wait, refusing to believe that paper prices matter anymore. This brings us to the most dangerous signal of all, the physical premium. In early January 2026, something happened that has never occurred in modern commodity markets. Physical silver in Tokyo and Dubai began trading at $130 per ounce, while COMEX futures showed $72, an 80% premium. Not 5%, not 10%, 80%. The price you see on your screen and the price you pay to take delivery have decoupled entirely. This is the definition of market failure. Let that sink in. 2 prices for the same asset, 1 price for the promise, 1 price for the metal. This has happened before in currencies during hyperinflations, when black market rates diverged from official rates. It has happened in housing during bubbles, when transactions occurred off-book at prices far above official comps. But it has never happened in silver, a globally traded commodity with transparent exchanges and supposedly efficient arbitrage. Until now. The mechanics of this divergence reveal the fraud at the heart of the system. For decades, the silver market operated on a simple premise. Paper contracts were as good as physical metal because you could always convert one into the other. COMEX held inventories. Bullion banks had stockpiles. If you wanted delivery, you paid a small premium and waited a few days. The system worked because most participants never asked for delivery. They rolled contracts forward, trading the price movements without ever touching the actual metal. This allowed the exchanges to operate with fractional reserves, issuing far more paper claims than physical bars existed in their vaults. Between early and mid-January 2026, 33.45 million ounces of silver were physically withdrawn from COMEX in 7 days. That represented 26% of registered inventory disappearing in a single week. Traders were not rolling their March contracts forward. They were rolling them backward, paying premiums to take delivery in January instead of waiting until March. This is backwardation in its purest and most dangerous form. It means the market no longer trusts that metal will be available in the future. It means time has become the enemy. Every day you wait is another day the vaults drain further, another day the gap between paper and physical widens, another day the exchange inches closer to an event it cannot survive, being forced to settle contracts in cash because the metal simply does not exist. COMEX inventories have fallen 70% since 2020. London vaults have lost 40% of their holdings. Shanghai inventories sit at decade lows. The math is simple and brutal. Global silver demand has exceeded supply for 5 consecutive years. The cumulative deficit from 2021 to 2025 totals 820 million ounces. That is 2/3 of annual global mine production, simply gone, drawn down from above-ground stocks to meet a demand that primary mines cannot satisfy. And now in 2026, the deficit is projected to reach 200 million ounces as China's export restrictions remove another massive chunk from the available supply. This is where the system breaks. You cannot run deficits indefinitely when the asset is finite. You cannot print silver. You cannot synthesize it in a laboratory. You can only mine it from the ground at geological rates that take years to increase. Unlike gold, 75 to 80% of silver comes as a byproduct from copper, zinc, and lead mining. This means silver prices can double or triple and production will barely respond because the economics are driven by base metals, not silver itself. The price signal that normally brings new supply online has been severed. Supply is structurally inelastic. Demand is structurally indestructible because silver is irreplaceable in solar panels, electric vehicles, semiconductors, and AI infrastructure. The collision between these two forces was always going to be violent. We are witnessing that violence now. On January 1st, 2026, China implemented export restrictions that transformed silver from a commodity into a weapon. Under the new licensing regime, only 44 companies are authorized to export silver. These companies must produce at least 80 tons annually and maintain credit lines exceeding $30 million. This effectively excludes hundreds of smaller exporters who previously serviced global markets. China refines 60 to 70% of the world's silver. They are not the largest miner, but they control the choke point. They take ore from Mexico, Peru, Australia, and refine it into bars that the world needs, and now they are keeping it. This is not a trade policy. This is resource nationalism. This is China looking at its massive solar build-out, its electric vehicle transition, its semiconductor ambitions, and deciding that silver is too strategic to export. The West can mine silver. But without Chinese refining capacity, without the supply chain that China dominates, the metal becomes trapped in the wrong form, in the wrong place, unable to flow to where demand exists. This is the same playbook China used with rare earth elements in 2010 when they restricted exports and forced Western manufacturers to move production to China or face crippling shortages. It worked then. It is working now. The market understood this immediately. Chinese buyers began offering $8 per ounce premiums over COMEX prices in late December just to keep silver inside their borders. Indian buyers offered $5 premiums. Physical metal began flowing east, draining London and New York vaults, concentrating in markets that value possession over paper promises. By January, the trickle had become a flood. COMEX faced delivery demands of 65 million ounces in late December, a volume the exchange reportedly struggled to fulfill. Rumors circulated of cash settlements, of contracts being closed out with dollars instead of bars, of force majeure clauses being quietly reviewed by legal teams. This is what a market in extremis looks like, when traders roll contracts backward instead of forward, when physical premiums hit 80%, when major exchanges consider cash settlement for commodity contracts, when central banks start buying silver alongside gold, breaking a 70-year taboo. Russia allocated over $500 million to silver reserves in their 2025 to 2027 budget. European banks, constrained by Basel III requirements that paper silver no longer counts as Tier 1 assets, are forced to replace derivatives with physical holdings. The race for the remaining 22,000 tons in London vaults has become a matter of national security. The United States designated silver as a critical mineral. The European Union included it in their Critical Raw Materials Act. This is not the language of commodities. This is the language of strategic resources, a material so essential that their availability determines industrial capacity, defense readiness, technological leadership. When governments label something critical, they are admitting that market forces alone cannot be trusted to allocate it. They are admitting that relying on international supply chains is a vulnerability. They are preparing for a world where access to silver is rationed, controlled, weaponized. Now we must confront the lagging asset, the contradiction that reveals the true nature of this crisis. While silver screams to $103, while gold pierces $5,000, while Bitcoin recovers strongly, the dollar index sits at 98.19, down only 9% from its peaks. This is too orderly. This is too controlled. If hard assets are exploding because currencies are dying, the dollar should be collapsing. Yet it falls slowly, grudgingly, as if the decline is being managed rather than market-driven. This is the central bank put in action. The Fed and its international partners intervening in currency markets, selling gold to suppress volatility, coordinating swap lines to prevent disorderly moves. They know that if the dollar breaks too fast, confidence evaporates completely. If the reserve currency of the world loses 20% in a quarter, the entire system destabilizes. So they manage the decline, they smooth the charts, they create the illusion that everything is under control, even as the fundamentals scream otherwise. But this management has a cost. Every intervention drains reserves. Every swap line extended is a liability created. Every gold sale is inventory destroyed. And eventually, the market overwhelms the intervention. Eventually, the gap between official prices and physical reality becomes too wide to bridge. We are approaching that moment. The 80% premium on physical silver is the market's way of saying, we no longer believe your paper. We no longer trust your promises. We will pay any price for the real thing because we understand that the real thing is disappearing. This is the final verdict. We are witnessing a regime change in how silver is valued, how it is traded, who controls it, and what it represents. The paper market built over decades, the futures exchanges, the London Fix, the COMEX warehouses, all of it was constructed on the assumption that physical scarcity would never matter because new supply would always emerge to meet demand. That assumption has failed. The geological limits, the refining bottlenecks, the export restrictions, the cumulative deficits, they have converged to create a reality that the old system cannot price. Silver at $103 is not expensive. It is revealing. It is revealing that the $25 silver of 2023 was a lie. It is revealing that the fractional reserve system in commodities is as unsustainable as fractional reserve banking in currencies. It is revealing that when trust breaks, when participants demand delivery instead of rolling forward, the whole structure collapses into a scramble for physical possession. The people holding cash right now are making a choice whether they realize it or not. They are choosing to believe that paper will retain value. They are choosing to believe that central banks can manage this transition smoothly. They are choosing to believe that the supply deficits will resolve themselves, that Chinese export restrictions will ease, that COMEX inventories will be replenished, that the 80% premiums are temporary dislocations rather than permanent repricing events. They may be right, but if they are wrong, the speed of the repricing will leave no time to react. The futures market trades 24 hours a day, but settlement takes T plus 2 days for physical delivery. When the breakdown comes, when the exchange admits it cannot deliver, those 2 days become an eternity. The price you see when you place the order and the price you pay when settlement fails will be unrecognizable. This is why traders are demanding immediate delivery in January rather than waiting for March. This is why physical premiums are exploding. This is why backwardation has become the new normal. Time is the enemy. Delay is risk. Possession is the only certainty. Silver breaking $111 is not the top. It is the beginning. The structural deficit is widening. Chinese exports are disappearing. Industrial demand is accelerating as solar, EV, and AI infrastructure build-outs intensify. Mine supply is constrained by base metal economics. Recycling cannot scale fast enough. Above-ground stocks are being systematically drained by investors who understand that this is not a trade, it is a survival instinct. When you combine structural shortage with currency debasement, with geopolitical fragmentation, with the breakdown of the paper pricing mechanism, you do not get a peak. You get a phase transition. The conservative analysts projecting $120 by year end are missing the point. The bullish cases targeting $150 or $200 are still thinking in terms of the old paradigm. If the gold-silver ratio compresses from 50 to 1 toward historical extremes of 15 to 1 or 20 to 1, if gold reaches $5,500 or $6,000 as central bank buying continues, If the physical markets fully decouple from paper pricing, silver does not trade. It gaps. It moves in $20 leaps that destroy shorts, that force margin calls, that cascade through the derivative complex and expose leverage that has been building for years. This is not good. These are not the conditions for rational wealth building. These are the conditions that emerge when trust fails, when systems built on confidence encounter limits they cannot negotiate away. The silver shock of 2026 is the financial system's way of telling you that something fundamental has changed. The rules that governed the last 40 years, the assumptions about fiat currency stability, about unlimited liquidity, about central banks as omnipotent stabilizers, they are being tested, and they are failing. You are not watching a bull market. You are watching a repricing event. You are watching the market's recognition that the emperor has no clothes, that the vaults are empty, that the promises were lies. Whether you act on this information or ignore it is your decision. But the clock is running. The vaults are draining. The premiums are widening. The system is breaking. And when systems break, they do not break slowly. They break all at once. And those who waited too long discover that there is no price high enough to buy what no longer exists in available supply. The silver shock is not coming. It is here. You are living through it right now.